today we're going to do two modules. One of them is reviewing macroeconomic developments, and the second one is going to be on economic crises as a prelude to, or as a background to understanding, what is arguably India's biggest current macroeconomic challenge, which we in the 2014 December analysis that we did, it's called the twin balance sheet challenge. We'll come to that in the afternoon. But originally this module was going to be the second module, but then we decided that you needed to do the monetary and fiscal module before we do this, because today, as I kind of almost promised, we want to give you a practitioner's perspective as well. I mean, cannot be just theory, and especially when there are students involved. I mean, you want the students to be able to, follow in practicality and on a real day basis how the economy works and how we monitor it and how we understand it. So in a sense, think of it today as all those who are watching today, all of you are going to be either the chief economic advisor, or if you're lucky, the governor of the Reserve Bank, or if you're even luckier, the finance minister of India. So you're going to be in that position, because we're trying to analyze the data from the perspective that these institutions do it. Now, why is it why is it important to monitor the economy on a real-time basis? I mean, it's obvious, right? We monitor it because we want to follow what's going on. We want to be alert to any problems that might happen. We want to, maybe policymakers need to adjust this policy stance in the light of all the data that comes in. And of course, there's a famous saying by one of the founders. I think he founded Intel Corporation. He said, Andy Grove, he said, only the paranoid survive. And so you have to be paranoid in terms of monitoring the economy if you really want to make sure that things are in good shape. I'm told that Alan Greenspan, I read somewhere that he was a manic data monitor. I mean, he used to monitor all kinds of data. He was just really obsessed with looking at all the data. Here we're not going to do it in that much detail, but I think we're going to see broadly how is it that we monitor the economy. What are the ingredients? What do we look at, and why? Okay, so first, standard, what we look at the components of macroeconomic stability. We look at what are the indicators for macroeconomic stability, what are the indicators for financial stability as well. So the first thing we look at, of course, is we look at what's been happening to headline inflation. And the person Ananya who did it, I wanted to give you hot off the press data. It's not been done. So headline CPI yesterday reached 2.2%, and that's not there. So that's and we just so we look at the data. We said what is headline? How does inflation behave? We look at that, and of course. We've drawn two lines. What is the target, the government and the Reserve Bank of India's target for inflation? The latest number is, so because this hasn't been done, I'm going to draw this for you because it's an important number. June, it goes from 3, it's come down to 2.2. So this is what it looks like. And we see where it is relative to the target. And of course, we do this also not just for headline inflation. We do this for other indicators of inflation as well, which, there's core inflation. So we look at not just headline inflation. Remember, because headline inflation has all these contaminated by, oil prices, agricultural prices. So we look at two other measures, something called core CPI, and that's the green line. And core CPI is you take away basically food and fuel from headline inflation and you get core CPI. But in fact, even that doesn't strip out the volatile elements from the CPI thing, because there are some components of services, transportation services which have oil prices, specifically petrol and diesel. So if you truly want to strip out all the volatile components, you take that out as well, and that's called true core, and so you monitor that. I mean, the reason you do this is because you say, well, the headline can jump up and down, but if you want a measure of underlying inflationary pressures, i.e. what you can expect going forward if the volatile component behaved itself, you should be looking at that. So for students, for example, I mean, I think it's a really good exercise to give them the NSSO spreadsheet, ask them to work with this, compute. I mean, is it possible that maybe there are other components also that should be excluded? It's a kind of exercise that they could think about. But, you know, so headline, core CPI, true core, different indicators of underlying inflationary activity. So when we look at growth, we look at a variety of indicators of growth. We say, okay, what's happening? And remember, when you look at the GDP data, and I'm going to come to that in a second, there are two ways you measure GDP. You measure it from the supply side, and that's called gross value added. And you measure it from the kind of demand side, which is called gross domestic product. I'll come to the intricacies of that. We're going to have one section on GDP data in India, which has kind of been very, very debated. We're going to have a session on that. Is this the time, team, to kind of go? Let's do the GDP data now to make it a bit more interesting. So, but let me just take you through the. So we look at growth, and it says it's going up, it's going down, why, etc., etc. And then we also look at, so what I showed you, the blue line is headline, i.e. what you see in the papers. But just as you could take out the volatile component of prices, you can also take out the volatile component of gross value added. And so what we've done here is we've taken out agriculture and government services and said, what does it look like? And you should catch me now. I said we take out the volatile component of GVA. But government we take out not because it's volatile, but is because it's, it's not, in a sense, we want to get at private sector activity, because government spending is something we control. It's something, we don't want, obviously, it contributes to GDP and demand and output. But just to get a sense of what would happen if government didn't spend, you take out the volatile component. And what you find, of course, is that it's very interesting in the last few years, when agriculture was not doing so well, you see growth of core GVA was above headline GVA. And in the last few quarters, as agriculture has started doing, because of the good monsoon, better than the rest of the economy, you see that therefore core GVA is actually doing slower than, so basically you're stripping out the component that's doing better than average, and so you get that. So, but in addition to this, we're all obsessed also with manufacturing. We also want to know what happens to manufacturing because, we give some primacy. We think that's a very good indicator of activity. We also think it's very important for a number of reasons, which we'll go into later. And then we look at manufacturing GVA as well. And we make this. I'm not showing all of this to you in order to kind of make any point saying oh my God or great or whatever. This is not about judgments on this, but just description, what you would show the students. I mean, what students should be looking at. That's why I'm showing this.
That one is not very clear as to what is this manufacturing GVA. Is it
manufacturing? Manufacturing.
Take out the volatile component.
No. Sure. We are just showing this is unseasonally adjusted. Just a headline manufacturing GVA growth. Quarterly. It's quarterly. Now I did want to, yeah?
This is organized or this is taking unorganized?
Everything. In the national income accounts, manufacturing GVA is a combination of this.
Small clarification.
Yeah, clarification?
This is headline GVA total or for manufacturing?
So headline is everything, MANU is manufacturing.
The data source is ASI or
No. This data source GVA is CSO. This is the statistics. I'll come to NSS in just a second. Now, again, as an exercise for students, I think, and for everyone, for all of us, There are two ways of looking at all these data. Ananya, can you just get to the relevant slide I'm just going to get to? So supposing you do quarterly or monthly data, the growth that we show is year on year. So December 2016 over December 2015. If it's March 2017 over March 2016. However, you can also do this in a different way. You can do, and this is what most advanced countries do, and also how the private sector does it. See, when you do year on year, it need not give you an indication of what's happening in the latest period. So what you do is, let's say you have monthly data, you say you have data for March, you say March over February, that gives you the sense of momentum. But March over February could be unusual because Diwali, Holi, whatever, right? So you have to seasonally adjust it. So what you do is you produce an index called a seasonally adjusted annualized rate. So you do, say, December over January, it's a monthly number, you have to seasonally adjust it, and then you have to annualize it to get what the annual rate of growth is going to be. You will see that in this period here, the period that's, say, May 16, August 16, the two are showing quite different things. And then you'll have to look at, why that's the case, which is the better indicator, et cetera, et cetera. So this is, so this is about, what you monitor and how you monitor. We've had some major changes to the way we do our GDP, and we've moved closer to international practices as recommended by the system of national accounts. The major change that's taken place is that the way we used to measure manufacturing on the high frequency basis used to be based on the index of industrial production, and then when it was revised 1-2 years down the road, it used to make use of the ASI, the Annual Survey of Industries. Now, what we do is, when we do manufacturing, for example, today, 70% is organized, 30% is unorganized. That 70% now is based on company accounts, not on IIP data. And the 30% that's the unorganized sector, we proxy it by the index of industrial production. And then there's some changes that we've used. Now you're using more tax data to get proxies for services sector growth. So the way we measure GDP in India is, we actually measure the supply side, gross value added. That is, sector by sector in the economy, agriculture, manufacturing, services, all the subsectors and the subsectors, we measure value added. That gives us gross value added. Then we just add net indirect taxes to get GDP. In India, we don't independently measure aggregate GDP. We measure GVA and we add this and get GDP. There are components of GDP: consumption, investment, exports, imports, government. And of course, inventories as well. We'll leave that aside. We use proxies for investment, basically IIP for capital goods and imports of capital goods for investment. Export and import, we get actual data from the BOP. Government, we get actual data from government accounts. And consumption is a kind of residual that you get. You cannot, directly proxy consumption, and then we have consumption. So in that sense, the aggregate GDP number is not independently measured from this. It's measured from the supply side, and that indirect taxes are added. So now, there are a whole bunch of complications on what we do when we do the quarterly accounts and what we do when we do the annual accounts, how we revised it. That'll be very boring for me and for you and the students, but actually it's something that you may want to get them to discover a little more. But what I'm going to more show you is, why has there been a controversy in India on the GDP data? So again, I'm not going to say good, bad, right, wrong. I just want you to know what the issues are in the GDP debate. We had the old series, which is the green line, and then the new series came out, which begins in 11-12. So 2012-13, we had the first growth number from the new series. So the first surprising thing that happened with the new series was, we got a huge upward revision here. And also, we got this increase and this increase over this year. So there was both a level jump in the series in terms of the level growth rate, and from 2012 to 2013, there was a big jump. So when this first came out, both Raghu Ramrajan and I, we raised the question about, because I mean, neither of us is an expert on this, but if you look at it from a macroeconomic point of view, the question that went through our mind, and of course, Raghu was here at that time, as governor of the central bank. Remember, 2013, July, August were the crisis months, and for almost half of that year, we had, highly unsettled, volatile conditions. We imposed a lot of restrictions on trade. So it was a period of a lot of uncertainty and volatility. And so the question we both raised were, how is it possible that in a crisis year, growth could increase so much? Now, again, we are not experts, we may not be right, but it's something worth thinking about. So, a statistician does his best and produces numbers, and which we should take very seriously because they do a terrific job. They're completely independent. They're not, people think they're absolutely under no political pressure to change things, and they do a really fine job, without any, pressure or anything. But, measurement is inherently tricky. Measurement is inherently difficult. Measurement is inherently susceptible to errors. In fact, many people say that this kind of precision that you see, 4.7, 5 point this, 5.5, 6.4, is actually very, very misleading because these things are subject to so much error that we should always think of these things not in terms of their exact magnitudes, but we should have kind of error bands around them. I remember once an Indian, very big Indian policymaker came to give a speech in the US, and I'm still struck by this in government documents. I've tried hard to do this, but my colleagues, I think, resist this still. All Indian documents, you will find economic documents, they always go up to 2 decimal places. Growth was 6.43%. How can it be possible, my friends? How can it be possible? There's such confidence bands around them. You should probably say, 6 to 6.5. 6.4 is bad enough, but 6.43 is totally ridiculous. So I'm joking, of course, but we still do it. But the point is that these things are subject to so much error that we should always see this more in terms of ranges rather than exact amounts. Yeah. My friend here supports me. You should join government and write the reports instead of some of my colleagues. So the first question we raised was this. Now, in the classroom, what I would like you to do, for example, if you're willing to, be open to this, is actually, maybe I'm wrong on this, go and look at what happens to the components of demand in 6.4. When growth goes up from 5.5 to 6.4 in a crisis year, is it possible? Maybe it's possible. For example, where could Raghu and I be wrong? Maybe that year, because there was a big exchange rate depreciation, maybe exports picked up very rapidly. Maybe things got so much better in the second half that they overcame, the problems in the first half of the year or the first 2-3 quarters of the year. So it's very much worth going and looking at how the underlying components behaved in this to see whether these numbers are plausible or not. But that was certainly the first kind of set of issues that was raised by this estimate. There's more coming. Yeah, question. Yeah.
The world has faced a crisis period from 9 onwards, and if you choose 11 and 12 as the base period to compare with, certainly the growth rate will be higher as compared to the base period of 2004 and 5. So to a great extent, this number 5.5 to 6.4 is actually a biased number. So far as
it's a good question. You're asking the question. He's asking the question of if you change the base year, it's quite natural that numbers will change. But here's the point, it's a very good question, but remember, what you said can explain the 4.7 relative to the 5.5, the 5 relative to the 6.4. But the 5.5 and the 6.4 are on the same base. Why did that change happen? So that's more a macroeconomic question. What you're saying is a little bit more of a statistical question, but it's a very good question, and that's worth looking at.
Just the last slide, if you can show the last slide.
Which one?
Last slide, this one. You are saying 70% data is from MCA 21 platform.
For the manufacturing sector.
Okay.
Yeah, because manufacturing is registered, unregistered. Unregistered, we don't have unregistered data except when we do the surveys every 5 years. So in between, we use the IIP to proxy. Good observation. I don't want to get into too much detail because in fact, beginning 2011-12, we have 6 lakh registered under the 6 lakhs. And my understanding is that that's a very comprehensive thing. That did not change between 2011, 12, 13, 13, 14. That didn't change. 11, 12. In fact, what happens is that you have, I don't want to get into too many details, but basically 2011, 2012, we had 6 lakh data. Initially, when the data came out for 13, 14, it was 3 lakhs. But then when you go and revise it historically 2 years later, you get the full sample again. The second big puzzle about the old data was that it was giving, the GVA manufacturing numbers growth and the IIP growth numbers were very different. Now, GVA, this is real GVA manufacturing, and that's IIP. Now, there's one difference between the two. The IIP is a volume indicator. How many cars were produced, how many tons of steel were produced. Whereas GVA, it's more how much. In principle, the difference is that, just to give you a simple example, if, for example, you have, you produce 1 car today and 2 cars tomorrow, it's a 50% increase. But if the second car that you produce is a BMW and not a Nano, your real GVA should be much more because that embodies more value added, more technology, more skills, more value added, and therefore the IIP number and the GVA manufacturing number are strictly not comparable because this is a volume indicator that's not. However, over short periods of time when all these technological things are not changing very much, we shouldn't see huge discrepancies. But here, the magnitudes of the discrepancies were huge. So just to take in the most egregious case, for example, if you take this and this, the difference was almost 10 percentage point growth difference between 2 series that in principle are measuring the same thing. However, good news and credit to our statistics department, the IIP manufacturing old, we recently, a couple of months ago, got the new, and you see the discrepancies. They don't get eliminated. They're still reasonable, but at least they get smaller. Yeah.
Yeah, one reason probably was that GVA is output minus input, and oil prices came down and all other inputs became pretty cheaper in that period of time. So your output volume may not increase, but the value added will increase because the cost is low.
So you are thinking like Raghuram Rajan and I did when this came out, and all 3 of us are wrong. I'll explain to you why. Okay, I'll explain to you why this is the case. In a question, that intuition which I also had, and I'm being honest with you, is exactly wrong. And I'll give you an example to show that. Because, okay, but the first thing I want to show is that with the old series, the discrepancy was pretty big. And with the new series, you see it's come down a fair amount. And notice that even now, so remember, this discrepancy came down, narrowed considerably. Now it's only so much. It's become smaller. And the reason, of course, is that the GVA is 11-12 base. The IIP old series was 04-05 base. So when you change the base, you obviously made it more representative. New products came in, new establishment, or the old stuff went out, the new stuff came in, and that's naturally why this happened. But notice that what this is going to do, of course, is that the IIP manufacturing will itself have an impact on GVA, because remember what I said, that 1/3 or 30% of GVA is measured by the IIP. So this is one. So this has raised another set of issues. Why are these things so different? About 2 years ago, I wrote an op-ed saying that, look, one of the striking things is that in India, because, and now this comes to the point that you just raised, because oil prices came down sharply, over this period, the WPI, which is basically has no services and a lot of oil, came down a lot, whereas the CPI was less affected by oil. Now, so remember, the WPI, at one point, the WPI and CPI, 8.5 percentage point difference in the CPI and WPI. Now, why is it important for the national income accounts? Now, it's important for the national income accounts in two ways. One is exactly the question that you raised. If input prices come down a lot, output prices don't. Why your intuition and my early intuition is not right is that the point that you make is exactly right. When you measure, nominal GVA will go up, but real GVA may not. Exactly. So, and this is exactly what this example shows. It's a very simple example. Time 1, supposing you produce 10. Time 2, also you produce 10, supposing. This is your input. All these are quantities. This is the price of your output. And suddenly this oil, because of oil prices, this comes down. And I don't want to, again, some of my friends, if you spot a mistake here, go straight to my team. They're responsible for this. But if this example is right, essentially what it shows you is that the current methodology will give you a 32% increase in real GVA, but the volume will give you 0, because basically, by definition, by construction, we've said quantities don't go up. And therefore, you get this, because the intuition is that actually when input prices come down, you have to deflate that away, not say that that's increased value added. So this was one reason why, one consequence of the WPI and the CPI diverging a lot. There was a second and much more, I think, something that people don't realize. Another reason why the WPI and the CPI have a big impact on the way we measure GVA. And I don't want to get into all the details, but essentially, there is about 20% of GVA, all services sectors, which we deflate using the WPI, and we use it deflating not individual components of the WPI, we deflate. So I'll give you an example. Storage services, we get nominal value added growth, and then we use the aggregate WPI to deflate that. So if the aggregate WPI is dominated by oil movements, and remember, always think about this conceptually. The way you should think about services and measurement is the following. Services in India especially are kind of labor intensive. So any services index should use wages and something related to wages as the relevant price indicator. Here, instead we use an internationally traded good, which is oil. So to deflate what's really a non-tradable, which is services and labor, we use a tradable goods prices, which is also very volatile. And that creates fairly large discrepancies between that. So, of course, again, in the new WPI series, it turns out that in the new WPI series, as you can see, sometimes this wedge has actually gone up rather than come down. So in that sense, we don't know which way the kind of measurement is going to go. Yeah, question.
So as researchers, when we use this new data, should we be taking any precautions, or if yes, then what?
Very good question. I think it's a very good question. Now, if I were a researcher, supposing I wanted to do something for which measurement of prices at GVA was really an issue, the way I would do it is this. I would say, okay, I am measuring the impact, let's say, of whatever, demonetization on growth. That's my research project. In that case, I would then say, okay, This is how I set up the model. This is how I set up the experiment. The outcome indicator of relevance for me is GDP or GVA. Column 1, if I take the national income accounts, this is the impact. Column 2, if I made 2 out of these 4 corrections, this is the impact. Column 3, if I made all these. So I think therefore as a researcher, I would urge everyone to take what the CSO gives. After all, they've put a lot of time and effort into it. But also as a researcher especially, you should see how can we, we know if there are some systematic things which are going wrong, how do we correct for that and do those corrections, and then see whether your results are very different based on whether you use one set of inputs or the other set of inputs. So absolutely. But I think that in order to become intelligent consumers of this data, I think, for example, like your students, like yourselves, like all of us, I think it's useful to know, what are the big kind of, it's easy to get lost in the details. You will find that, if you go at, because for every sector, every subsector, there are proxies, there are alternative choices possible. And so, that's one way of looking at it as well. But I like to look at it more in terms of what are the factors that can have a kind of macro impact, not that can change growth from 6.5678 to 6.5679, but can it be 6 instead of 6.5? Because that's a big change in the numbers. And those are the things that I would look into if I were a researcher. But that's a great question. So I have now concluded the discussion on GDP and GVA. Any questions on this? Yeah, please.
This is just a clarification about the new index of IIP, new series of IIP and the old series. So what is the basic difference? If this is a quantity indicator mode of, then how come the change in base year lead to that much of divergence?
So that's very easy, because remember in 2004-5 you pick the sample that you're going to follow based on what you think is the distribution of in this case manufacturing in 2004-5. In 2011-12 we know that, for example, that IT is probably becoming a much more important part, right? Computers, an iPhone probably showed up in 11-12 and all those things. So you have to, in a sense, basically what you're saying is that those activities that were important in 04-5, give them less weight now. Those that were less important have become more. So the base revision is actually quite important. Then, in fact, what they do is they also then, the way they measure it, they decide not only this product differences, but also within that, which establishments to monitor and which not to monitor. So it's a very important change to make. At the back, and then I'll come to you. Yeah, at the back, please.
So beyond the statistical problems, there's actually an interesting pedagogical thing I want to take your view on. When you talk about value added and you talk about prices, the oil example, to the extent that prices are actually a product of political economy and not purely competitive market forces, would you as a teacher, try to get this point across that value added itself becomes a political economy category because it's coming out of prices and prices are determined by a whole host of such factors?
See, now you're getting into dangerous Marxist terrain, which I don't want to get into. I think that there are some friends here who are strong Marxists, my colleagues, more Marxist than I am. But no, in this case, I would not get into that. You see, the things that I'm going to argue, the point is oil prices are a product, everything is a product of politics and economics in that sense. So where do you draw the line, and then you get into it. And then you get into, well, is the oil price itself, oh yes, it's a cartel, but how effective is the cartel? Sometimes they've been effective, some ineffective. It's kind of hairy territory. I would kind of stay clear of that. There are other interesting questions to examine than that one. I'm going to take 3 or 4 more questions because important, but then I want to move on. Yeah.
Now, this is for our knowledge only. Has the ministry or the government started thinking about including time use in the national accounts?
Anyone, my colleagues, time use, what is the answer? They are thinking? We don't know for sure. We don't know for sure. Maybe they are, but we don't know for sure.
It is estimated that if this will be included in our national accounts, our GDP value will exceed to many countries, even China also.
Yeah. Again, I don't want to get into the rights or wrongs of that, but I don't know the answer to that. Remember, in all these things, always remember there's the level effect and the change effect. And maybe they don't do time use in China as well. Maybe there won't be a difference between India and China. Maybe they don't do time use. So you have to keep that in mind always when you say, oh, we can boost our economy, but so can others. There are infinite ways, there are very few. It's very hard to increase real GDP through policy. It's, quite easy to increase it statistically. Okay, now let's go back to now for a moment, you were the chief statistician. Now you go back to being the governor of the Reserve Bank or the finance minister. And so we've looked at inflation. We've looked at growth and how we look at it. We did a little bit the GDP numbers. Now we want to go into we also look at the external sector. Now here, again, this is something I feel very strongly about, especially, looking at all the tweets that are coming in and so on. We want people and students to learn and to know. So again, in the external sector, what do we monitor and why? We monitor the current account deficit, yeah? And normally, you see it coming down, you say fantastic, no real external vulnerability. But there is a kind of rough rule of thumb that's used all over the world that essentially if the current account deficit is less than 3% of GDP, things are relatively safe. Beyond that, countries start getting vulnerable. And the reason for that, of course, is that, it's not a hard and fast rule that's, kind of some big mathematical basis, but essentially what we say is that the larger the current account deficit, the more you require foreign capital to finance it. And because you can't rely on foreign capital, the more you rely, the more vulnerable you get. And historically, we've seen that, when countries get above 2.5%, 3%, they're more prone to having this, money going away, and then you get, exchange rate trouble and difficulties of financing the current account deficit. And then if you don't have enough reserves, then you're in trouble. Another indicator we monitor is foreign exchange reserves. So that chart shows you the line, 300 was what the Forex was at the advent of the financial crisis, and today it's gone up. So we think, but here again we use rough rules of thumb. There are two ways of monitoring whether reserves are adequate or not. One is from the trade point of view. So essentially you want to say, look, this is like an insurance mechanism. So if suddenly something goes, will the country be able to import enough, oil, whatever it needs, the essential commodities, food, oil, do you have enough? And so a kind of rough indicator is that you should have reserves, foreign exchange reserves, equal to about 12 weeks, 3 months of imports. In 1991, when we were heading to our crisis, our reserves had dropped to 3 weeks or 4 weeks of reserves. That's when the panic set in, and then all the gold that had to be flown happened. Now, but that's looking at reserves from a trade point of view. More and more now, we see that, everyone is becoming open to capital. We also want to see whether reserves are enough in case something happens to foreign capital going in and out. So one measure that we use is how much of your short-term debt is covered by reserves. Because remember, short-term debt is anything that's going to mature within 1 year. And then, so this measure goes back to a Mexican central banker called Guidotti, and then Alan Greenspan picked it up. It's called the Guidotti-Greenspan rule, that if your reserves exceed your short-term debt, that means you're in a relatively comfortable situation, because even if all the short-term debt, was not being rolled over, i.e. people, short-term debt is usually rolled over. If it's not being rolled over, that means you have to pay them. And do you have the foreign exchange to pay them or not? And that's why we look at foreign exchange reserves as well. Then we also look at FDI and different, because not all forms of capital inflows are the same. You can have many, many different kinds of capital inflows. One, you could borrow from the World Bank or development. So that's called development assistance. In the old days, we used to have a lot. Now it's very negligible. We don't rely on foreign concessional financing. You get FDI, you get foreign portfolio investment, and you also borrow abroad in foreign currency, which is called in India's case, external commercial borrowings, ECBs. Now, generally, again, the rule of thumb is, even look at this. This actually brings out the difference between FDI and portfolio. Look how portfolio is much more volatile. FDI is less volatile. So we think of foreign direct investment as, because it's kind of basically investment in plant and machinery. Foreigners are coming and putting up plant and machinery, which they're not going to take away because, it's a big lumpy investment. We think that this is a more stable flow of foreign finance. The other is less so. So for example, I don't know, in the last few months, you must have seen lots of people saying our current account deficit is very sound because most of it or all of it is financed by FDI. So then you feel more stable, more comfortable, but if it's financed more by fickle foreign investment, you tend to worry much more about that. So that's why we look at this. Then we also look at exchange rates, because as we're going to do later on, many crises that happened because the exchange rate became too strong, and as a result, a kind of a currency collapse happened. So, but this is also important because we want to measure, see, exchange rates, again, I want to show you, has two impacts. One is the price of imports, and the other is what it does to your exports. So we monitor actually three different kinds of exchange rates, or three versions of the exchange rate. This is something that, it seems, maybe it's very basic for all of you, but it's something that I think students really should know why we monitor what exchange rate. First, we monitor the rupee dollar rate. This is the most kind of visible rate. That's what all the newspapers will tell you. The rupee went down, the rupee went up. And they will not even tell you whether, they will only focus on the rupee dollar rate. So for example, and remember here, a very misleading thing, please alert students to, if it's coming down, actually that means the rupee is becoming stronger. Normally you think of coming down as bad. Well, it's bad or good, that depends on your point of view. But basically this means it's strengthening, not weakening. It's something that you should alert. The axes are very important. So that the rupee dollar rate is very important in many senses, but the first sense is that all your imports that are denominated in dollars, oil, etc., will be and many of your inputs will be affected by this. So domestic inflation, for example, if your currency appreciates against the dollar, there will be a downward impact on domestic prices. Conversely, if the rupee goes down, there will be an upward impact on domestic prices. However, that only tells you what's happening vis-a-vis the dollar. Why should we only focus on the dollar? We should focus on lots of other currencies as well. After all, we trade with other countries sell us goods, we sell to other countries. So we have something called, so the green line is the bilateral dollar rate. The orange line is what is called the nominal effective exchange rate. That means it is measuring the strength of the Indian currency against a basket of other currencies. And typically this basket, it's done by the RBI, but the IMF has a different basket, for example. They will look into what are the countries we trade with and assign those countries kind of weight. So if you trade a lot with the US, it'll have a greater weight. If you trade a lot with China, it'll have weight. But then you could also do, for example, I want to look at not just the countries I'm actually trading with, but who I might trade with or who competes with me in third country markets. So that's how you get this. And what you see broadly, of course, is that the dollar rate and the nominal effective exchange rate broadly track each other. By the way, again, it's convention. The rupee dollar rate coming down means currency, the rupee is strengthening. The NER going up also means the currency is strengthening. So so this is for all students, I will tell you. So if I were to presentation, I would grade myself C- for this chart. I give myself C-. It's very confusing. We should either make clear, or in order to show that the two move together or differently, both of them should have been done in a way that downward movement is, depreciation under both, upward movement is under both. So we have I give myself a C- for this chart, and my team a C- as well. So essentially what we do is that we take, so the rupee can be strengthening against the dollar, but it can be weakening against the Chinese currency. So you take a weighted average of what happens of the rupee rate with other countries, where the weights are determined in the manner that I said. Okay. Now, what will answer your question is, now we go to the next chart. So bilateral nominal effective. So the only change between the green and the orange is, in the green there's one country, in the orange it's against all currencies. Then we go to the real effective exchange rate, which measures in fact how the economy is becoming competitive or uncompetitive. Can anyone say what the difference between the two is? With a mic.
It's the relative price differentials between between India and rest of the world that will
exactly. So, very good. So what that does is it tries to measure the competitiveness of a country. So if your exchange rate is going down, depreciating, you are gaining competitiveness. But if inflation is also going up, the amount what you can price in dollars will be affected. You will lose competitiveness if your prices are going up. Similarly, if the foreign currency is, if foreign inflation is going up a lot relative to your inflation, then you are going to be gaining competitiveness vis-a-vis the foreign currency. So the real effective exchange rate measures is the nominal effective exchange rate, and then the relative price movements in India and partner countries, and the weights all weighted in exactly the same way as this. You take into account all of these countries, and then you do that. And here what you generally see is that if it's going up, that means the currency is becoming uncompetitive. We are losing competitiveness. And why we do this is because we look at the dollar rate to see the impact on inflation going forward. We look at that because we say, wow, will this have an impact on my exports and imports going forward? So this again is a kind of monitoring device to assess what future prospects are going to be.